So what happens in a rising rate environment and what should you expect?
Welcome to your Money Monday.
Welcome to session 309, brought to you by the Mott's team with Cutler Real Estate. So Len Kiefer, the deputy chief economist with Freddie Mac, actually said this: mortgage rates are likely to continue to move higher throughout the balance of 2022, although the pace of increases is likely to moderate. So less crazy fast pace of rates going up. Thank God, because most of us saw, didn't even see the fours, I should say. Rates were in the threes and boom, next thing we know they're in the fives. And right now they're between 5.25 and 5.75 in most of our markets. So much of these increases in rates happen early in 2022 in anticipation of what will happen later this year, especially in the Federal Reserve interest rate policy. And the Feds just last Thursday bumped it up a half a basis points as far as the Fed Reserve interest rates. So there we go. So the impact of rising rates on home prices. A lot of people think, hey, rising rates mean that home prices are going to drop down. But here, with all this data right here, folks, really home prices actually go up an average of 8% here. You can look over the years since the 90s through 2012. Anytime that rates went up greater than 1%, home prices went up about 8% on average. So there's something that's going to surprise a lot of you. Another thing, a lot of people think home sales are going to go down in volume, so because of rates jumping. Okay, so this is also from the early 90s. And so this first slide, it looks like home sales will go down about 11% total in volume, like number of homes sold. But here, let's take a look at this next slide where it's X'd out in the 90s and in 2005 and 2006 where we had the mortgage crisis, where, the housing crisis they call it, but I call it the mortgage crisis. So in the 90s, the first one it's crossed out, rates went up nearly like almost 10%, 9.2%. So we're not in that kind of market, so we can kill that one, strike that off there. And then the other market was the anomaly, can't even say it, of 2005, 2006, when the housing market crash impacted everything. It went down 14%. So you take those two things out of there and we're pretty much at, even, minus 2%, plus 2%, as you can see in the chart here. Okay, so what's this do to people? It gets people off the fence. So one way or the other, some people go, whoa, I'm getting out of the market totally for a while, rates are too high. And other people go, man, I'm going to jump in before rates go up any higher. And yes, they are going to go up higher. So let's talk about what 5.25 to 5.75 actually means to you. Look at mortgage rates by decades. Okay, the 70s, they're 8.86. The 80s, they're 12.7%. The 90s, they're at 8.12%. The 2000s, 6.29%. And 2010s, they're like at 4.09%. So you can see that rates historically have been a lot higher than the fives that we're crying about right now. So they're not bad. So the difference your interest rate actually makes here, this is a great slide to look back to. Actually, in 1985, rates were 12.17%. So to get a home for $1,000 or under your payment, you could actually buy a home for $95,700 in 1985 with those rates. Okay, in 2000, you can see that 8.12%, $134,500 you can get a home for. And now today at 5.25, you can get about $176,000 worth of homes. So if you look back historically, this is not bad news, really, these rising rates. Home appreciation since World War II, you can see that it went nice and steady until it hit the 2006, and then it dropped with the housing crisis, and it's picked up and went right back on pace again. And you wonder why it dropped off in 2006. Look at this next slide with the default risk, the big red spot there of where they were just giving away loans. That people were using their homes like ATM machines, and there was bad loans being done out there, and that's why we had the market crash. Today, it's nothing like that. Nationally, homeowners in Q4 of 2021 had an average of $307,000 in equity. So we're not where people are totally owing, less than what they what their home is worth. So instead, people have an average of $307,000 equity in their home. So that's crazy good stuff there. Hope you understand all that going on there. Home price forecast for 2022, 9% looking for actual average of what home prices are going to do this year. Then we look at estimated home price performance here, and it's 9% for this year, and then you can see through 2026. And what's that mean to you? If you bought a home for $360,000, it's going to be worth $96,342 more 5 years from now, based on the average appreciation that the best experts are actually predicting. So if you buy a home for $180,000, then it's going to be worth $48,000 more at the end of 5 years. So I hope that puts things in perspective for you and say it's not so scary to pay a little bit more for a home right now. So what's all this mean to you? If you need to sell a home, how much is your home worth right now? Go to yourincreasedhomevalue.com to find out the price of your home within minutes to your email. And if you're considering buying a home, get some great stuff from us with the Mott's team and go to buywithmottsteam.com, and we will email you a free things to consider when buying a home guide for spring of 2022. And for the best information on real estate listings, go to themottsteam.com or contact Teresa, Heather, or myself if you want any more information on buying or selling a home. Thanks so much. Have a great day.